It's hard to find values in just about every sector of the market except for the real estate sector.
This is the only Dividend King in the REIT space.
I love how this company uses demographics. They only invest in real estate in very affluent areas.
And they don't have to deal with what I call the 3 T's, the taxes, the trash, or the toilets. They just collect that land rent.
I love collecting that monthly dividend, and I'm sure I will for many, many years to come.
Hi, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show, the Halloween edition, where Nick and I are going to be talking about some really good REIT treats today.
Yeah, no, we got to love that. Like we said in the last video, kind of part 1 of this series, a lot of the market's overvalued right now. It's hard to find bargains. We record these on Monday. It's another big green day. You know, I looked at my portfolio. I'm at an all-time high net worth. That's great. But I do have some cash I'd like to invest, and I'm having a hard time doing so. It's hard to find values in just about every sector of the market, except for the real estate sector. I think Brad's right. There are a lot of great values here, and that's what we're going to highlight today, some of his favorite REITs to buy. So I'm going to sit back and enjoy the show and see what Brad's favorite Halloween kind of trick-or-treat candy REITs are this year.
Yeah, I mean, I've been doing this every year, this Halloween edition, and I really get excited. I'm glad I can do this now on YouTube. Now, many of you know that Nick and I both are students of Benjamin Graham. And I want to provide you with a quote real quick that really ties into our sleep well at night Halloween picks. Again, this is Benjamin Graham. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. One of the most persuasive tests of high quality is an uninterrupted record of dividend payments going back many years. We think that a record of continuous dividend payments for the last 20 years or more is an important plus factor in the company's quality rating. Now, it's the consistency of these products that creates consistency in these profits. Consistency and durability are attributes for competitive advantage. And that's really what we try to look for here at Wide Moat Research. Not all of our companies have records of dividend growth, but a large majority of them do. So Nick, do you have any thoughts, again, in terms of our REIT allocation within Wide Moat?
No, yeah, I think we, in our front end portfolio, the Wide Moat letter, I think we have more than 10 REITs now. I feel very good about all of them. We picked kind of the creme de la creme. These are blue chip REITs, very safe dividends. I love that quote. Every time if I go into Reddit, Dividends Reddit or someplace, there's always some hater that says, well, dividends aren't free money. It's just the company's taking a bit of its profits and giving it to you. And then therefore the value of the company should fall by the dividend amount. And it's just a wash. Like you're not really getting anything out of that. But, I guess theoretically that's true on that day, on the ex-dividend day. But over the long term, that Graham quote speaks volumes. A company that's able to pay dividends, consistently growing them for a long period of time, it just shows how incredible the business is. That's how you make money in the market. You buy and hold wonderful companies. That can be hard to figure out sometimes. You wonder about competition and disruption, innovation, all these things. Well, one of the simplest screens, and it is backwards looking, but one of the simplest screens to run is has this company been able to not only pay a dividend, but grow a dividend over a long period of times. Graham probably wrote that in the 1930s or 40s. So let's think about nowadays, the last 20 years, all the crazy things that have happened in the world for 20 years. So any company that has a 20-year plus dividend growth streak today, they've managed to navigate all of those kind of turbulent waters while continually growing their profits and paying a sustainable dividend to shareholders. So no, that doesn't point into the future. There's no guarantee that just because a company's paid for 20 years, they'll pay for another 20 years. But it does point towards, very capable management and, a very durable business model. And, that's something that I'm willing to put my trust in. So, I disagree with all those people that kind of hate on dividends, that say that it's a wash, it's not free money. No, it's not free money, but it does point towards this is the type of business that I want to own over the long term.
Yeah, for sure. And, again, REITs have these contractual leases, and that what makes REITs, I think, superior to a lot of different asset classes because as an analyst or investor, we can predict to a higher level of certainty future earnings. And so that's what we're going to be talking about here today: earnings, dividends, and really 3 REIT treats. Starting with my first REIT treat is Federal Realty. Federal Realty is a shopping center REIT that's focused primarily on shopping centers. They do have residential and mixed-use properties as well. Roughly about 103 shopping centers, very high-quality shopping centers, I might add, 3,000 residential units and 2.3 million square feet across many markets, mostly densely populated. One of the real advantages for Federal Realty is the fact that it generates a lot of income from these core affluent markets, which are supply constrained. Markets like Miami, Phoenix, Southern California, Philadelphia, Boston. These are the core markets. I put a map here showing where those properties are located. So that's one really important differentiator for Federal is demographics. Secondly is the balance sheet. The company has been an excellent capital allocator. They've acquired around 22 projects, around $2.1 billion since 2019, and they've sold around 24 properties worth about $1.1 billion during that same time period. They also have a very active development pipeline, which generates yields, cash-on-cash yields of about 6 to 8%. So that's certainly accretive when you look at their overall cost of capital. Now, the company has about $1.5 billion of liquidity. That's as of the second quarter. They haven't announced the third quarter results yet. Credit metrics are extremely solid, 5.4 times annualized consolidated net debt to EBITDA and 4 times fixed coverage charge. Now take a look at this next chart. This is the earnings or AFFO per share. You can see during COVID, they declined from around $5 a share to around $3.41 a share. But you can see here too, they've also clawed back that earnings or that AFFO per share, and now they should top $5.36 per share this year, which is an all-time high. So they definitely have clawed back out of the COVID environment. What was really interesting, and of course, we've been covering Federal Realty for quite some time. I pulled up this. This is a quote that Don Wood, the CEO, said about the dividend during COVID. Again, they didn't have enough earnings to pay that dividend. But let me tell you what the CEO said during COVID. He said, "We have, as many of you know, increased the dividend every year since 1967. It's an important record for us, but it's not something that could not be broken to the extent this pandemic carried on for a number of years. But it is something that's important, and we do see a path on the other side to continue to pay for it. So that's what we're trying to do." Now, take a look at this next chart. I showed you the earnings dropped during COVID, but look at the dividends. They just kept going and going and going. Now the company has a 58-year track record of increasing dividends. That is the best track record. This is the only Dividend Kings. Dividend Kings is a company that increases their dividend for 50 years in a row. This is the only Dividend King in the REIT space and one of just 56 U.S. public companies with that Dividend King record. So definitely high quality. Going back to the Ben Graham quote, it's a quality business model because they have done this now for 58 years in a row. Now look at the valuation. This is one I want to provide buys for you here today. So you can see here using fast graphs, shares are trading at about 19.1 times. That's about 20% below the normal multiple, which is about 25 times. You can see that here on the fast graphs. This means there's a margin of safety, and also it reflects a really nice attractive dividend yield of 4.5%. You don't get that type of dividend with that type of sell-off. So that's a good time to be buying this particular REIT. Now, in terms of analyst estimates, the company should grow earnings by around 7% this year and 6% next year. So that's fairly decent growth. So my conservative total return estimate based upon that dividend yield I mentioned and price and growth, 6 to 7% growth, plus a mean reversion, maybe not even back to normal. If we be more conservative and kind of move closer in, we're talking probably 25% total return possibility. That's our forecast for Federal Realty. Nick, any thoughts?
Yeah, no, I like this company a lot right now. Like you said, 4.5% yield, high single digit earnings growth. Even if we don't see any multiple expansion and the stock continues to trade, at this sub 20 times level, which is a massive discount to its historical earnings, that still points towards double digit annual total return. So that's attractive. We talk about my football team all the time on this channel, and we always tell the kids, control the controllables. players play, coaches coach, referees referee. We can't change what's not our job. I love how this company uses demographics. That they control their profits in a big way because of their demographics. They only invest in real estate in very affluent areas. On all of their investor decks, they talk about the average household income within a 3-mile radius of their shopping centers, and then the average population density. And both of those numbers are typically higher than their peers. So I like that. I think that makes a lot of sense. Even during economic downturns, wealthier people will continue to shop. Therefore, the businesses will stay open, and the landlord, which is FRT, will continue to collect rent. And then I also like their mixed use kind of portfolio. That's where they're headed, I think. I think that's the future for them. And as far as controlling their controllables, they're creating sort of symbiotic ecosystems that work out for all their tenants with these developments. Having the residential, the big apartment buildings there, that creates customers for the retail clients. And then having all this retail people with all within a walkable area makes the office buildings more attractive to those companies, because everybody wants to build a walk to lunch and have nice green space, et cetera. So they're creating these kind of utopias for people to live in. And I think it makes a lot of sense. Their business has talked about these are long-term projects. There's a lot more red tape involved when you have to get residential and commercial and retail, all these things together. So not very many companies can do what Federal Realty does, but they're able to do it because of their size and scale and kind of long-term view, which not all publicly traded companies have. So I really like FRT here. If that's your first pick, I'm looking forward to hearing what the next two are.
Well, the next one also ties into demographics, and I've talked about this on a couple of shows before. This is Equity Lifestyle Communities. This is a leading owner and operator of manufactured home communities, RV resorts, and campgrounds, all in North America. They have 455 properties, so very diversified. That's 173,000 plus total lots across 35 states and Canada. Now they're located, this again, tying into demographics, they're located in these retirement and vacation destinations. They have a lot of their properties, about 25 to 30% of their properties are either on lakes or rivers or oceans or frontage. And 70% of the manufactured home properties are age qualified, which means they have residents that are over 55 years old. Now, this makes this particular revenue stream extremely sticky. People are going to stay around for a long time. And there's a couple of reasons. This business model really is important to understand. I think it's one of the best business models out there because the landlord, Equity Lifestyle, owns the land and leases the sites to its owners of these homes, or the cottages or whatever they have, RVs. And so, the tenants own these properties. They own the homes or the cottages or the RVs or the boats in the case of marinas. And so they've got almost an equity interest in the land that Equity Lifestyle owns. And it's very hard to move these. I mean, once you set up your manufactured home and you've got your landscaping in and all of this, all the utilities are hooked up, and it costs money to be able to pick this stuff up, hire a mover and then go plug it into another location. So these things are in at a pretty long period of time. And again, from a landlord's perspective, it's really almost virtually risk-free. Obviously there's risk, but virtually risk-free because they don't have to, all they do is pay land rent essentially. And they don't have to deal with what I call the 3 T's, the taxes, the trash, or the toilets. They just collect that land rent. And that's a really, really important part of this business model. The other thing I want to mention with Equity Lifestyle, another kind of the moat advantage, is the company's balance sheet. Again, probably one of the best balance sheets out there. They got an enterprise value of about $16 billion with really strong credit metrics. The debt to enterprise value is just under 21%, and total debt to adjusted EBITDA is about 4.5 times, and just 3% floating rate debt compared to the REIT average floating rate debt's about 10%, and only 6% debt maturities through 2027 compared to about 24% debt maturities through that same time period, 2027. So definitely they've done a really good job in terms of their capital management. Now you can see that reflected here in the earnings chart. This is the AFFO per share. And this thing is just straight up. It's like a stair stepper all the way up from really coming out of the Great Recessions. They had a very modest earnings decline in the recession. So virtually kind of just navigated right through the Great Recession And since then, they've generated about 8.4% FFO per share growth from 2006 to 2024. So the dividend growth, which is the next chart I want to show you, is absolutely spectacular. 20% CAGR growth from 2006 to 2024. So if you want a company that's going to grow its dividend over time and keep growing and growing and growing, this is what you have with Equity Lifestyle. Now, one other thing I want to mention, many of you probably know Benjamin Graham owned or bought a company called Clayton Homes in around 2003. Now, Clayton Homes is a manufactured home business. They acquired that company for about $1.7 billion back then. In 2024, Clayton built 60,000 manufactured and on-site homes, generating $12.4 billion in revenue. Now, given that, I'm kind of surprised Berkshire Hathaway hasn't stepped in to take a position in Equity Lifestyle. They did recently with Lamar Outdoor. We wrote about it in the Wide Moat Daily. But again, this is a company that I believe Warren Buffett should definitely take an interest in because of his tie-in to Clayton Homes. Now, the other reason I think Warren Buffett should buy this is valuation. Put together a fast graph again, highlighting the margin of safety you can see here on this chart. Now, shares are trading at 23.7 times compared to their normal valuation of around 30.4 times. So you see that valuation gap right there in front of you. The dividend yield is 3.4%. That's fairly decent. But again, I'm talking about dividend growth and how they've been able to grow that dividend for around 20% CAGR. So we definitely know this company is going to continue to growing that dividend. Now, in terms of my setup for this, I'd like to be a little bit conservative here. Again, but the demand drivers are all there. The aging population, the migration to the Sunbelt markets, and of course, interest rates are coming down. We know that. We've been writing about that a lot here at Wide Moat. So we see Equity Lifestyle potentially generating 30% annualized returns. We could drop that back to even 20% annual returns. So somewhere in that range, more conservative, probably 20%, more aggressively 30%. But all the ingredients are there for this company to outperform over the next 12 months.
Yeah. You said Benjamin Graham bought Clayton Homes. So just correction. Obviously, we're talking about Warren Buffett. Benjamin Graham was not alive in 2003. But yeah, that's okay. I just want to correct for everybody. But we talk about investing behind secular trends here at Wide Moat. How do we sleep well at night through short-term volatility? It's because we're sure that our investments have tailwinds behind them that are secular in nature. They're very strong. So the silver tsunami is certainly one of those, the aging population of America. These people want to go live somewhere. Where do they want to live? They want good weather, low taxes, et cetera. So they're leaving urban coastal markets a lot of the time and headed south. That's the other trend, the southern migration that Brad has talked about. We're seeing that play out. You can look at electoral college seats projected in the next election. You see which states are losing them, which states are gaining them. That's a pretty easy way to show, where people are moving within the country. They're headed to Texas, they're headed to Florida, Alabama, Georgia, et cetera. So yeah, I like that pick. Brad talks about it all the time, but when you talk about 20 to 30% upside, you see why. The company's still growing, its valuation's cheap, and in the meantime, you get a solid dividend yield. So, it checks a lot of boxes, and, looking forward to, checking back in a year and seeing where ELS shares are.
For sure. Well, the last pick, and I'm sorry about the mix up with Benjamin Graham and Warren Buffett, but Benjamin Graham should have bought this particular REIT, this next REIT, and Warren Buffett should be buying this next REIT. And it is perhaps, I think, one of the best REITs to buy today. And I know I pounded the table about this a lot, but I'm going to show you a little different angle on this company because we've talked about Realty Income quite a bit here. And by the way, Realty Income is actually performed very well this year. So if you watch some of our videos earlier in the year, I think shares are up around 15% or something like that. We have return year to date. So I'm glad if you listen to us then, you should be in pretty good shape. But we still believe Realty Income is a buy here today. And I'm going to tell you why. Now, the company is highly diversified. I'll show you the map again, 15,000 properties, 50 states in Europe. So they're spread out geographically, as also in terms of their operator base. They've got a number of different operators that really drive this revenue. So it's not just one tenant. If they have a problem with one tenant or one customer or one client or even one category, that's not going to be the end of the world. And that's been demonstrated through not only recessions, but also through COVID. They've been able to continue to grow their earnings and grow their dividends, really through any cycle condition. Now, what I want to talk about, though, is just the whole scale advantage of Realty Income and how they've been able to really move into a lot of different verticals, because this is a very highly fragmented market. I've got a screenshot here. You can see Realty Income has begun to move into different categories, like industrial. Years ago, they didn't own industrial properties, which are some of the best properties to own today. Also, they've now expanded into Europe, as well as the gaming sector and the data center sector, and that's given them a whole lot bigger sandbox to invest in. Throughout 2023 and 2024, they deployed about $13.4 billion, including nearly $6.8 billion in 7 different unique transactions. And I also put a chart here showing these transactions. They were able to source these properties, access the capital for these properties, and again, diversify into these other segments. So again, that's also increasing the value of the company. And the market doesn't really recognize the machine that was being built. Now, another way they've been able to fuel this machine is their balance sheet. Again, they're A-rated from Moody's and S&P. And that allows the company to have low cost of debt. They had over $2.6 billion of liquidity in the second quarter, which is about $580 million of cash, $1.8 million of forward equity, and of course, about half of their revolver was outstanding, about $1.9 million of their $4 billion revolver. Now, we already have seen earnings with Agree Realty. Agree is a competitor of Realty Income. That's ticker ADC, another company we follow, and definitely great company to own. A little bit expensive today, or maybe more closely to fairly valued. But what's interesting is they have announced their third quarter earnings, and they had their investment volume, their acquisition volume was the largest they've had on record, which is about $450 million, which means they also raised their guidance to $1.5 billion to $1.65 billion. Now, why is that important? Because I think Realty Income, their earnings are coming up. I think we'll see them increase their guidance as well. Really, the stars have lined up for this net lease space. They've got all of these different assets they could look to own, all these different verticals, all these categories, all these markets. And again, they've got this low cost of capital advantage. So I'm definitely looking to see if Realty Income bumps that their acquisition guidance and possibly their AFFO. Again, Agree did it as well. I want to also highlight something here, and this is why I wanted to make this a little different subject related to Realty Income. Now, I put together this chart. This is the earnings chart, but I want to show you the M&A activity that occurred with Realty Income over the last 12 years. Now, in 2013, again, I've been covering this company for 16 or 17 years. In 2013, they acquired American Realty Capital. It was about a $3 billion deal. And you can see that. I put the logo here on the chart for American Realty Capital. Then in 2021, November of 2021, coming out of COVID, they acquired REIT, which is also a company that was tied into another company owned by American Realty Capital. And then they ended up acquiring again. By the way, REIT had some office property, so they spun out the office into a company called Net Lease, ONL. And then in 2024, January 2024, they acquired Spirit, which is a $9.3 billion deal. And again, we predicted that was going to happen as well with Spirit. So, but you can see on the chart, all of those periods, these were accretive. They were able to actually increase earnings more significantly because of those acquisitions and kept growing and growing and growing. Now, the next chart, again, going back to Benjamin Graham, we want to see companies that have increased for at least 20 years, according to Graham. Well, this company has done a really good job of that because they paid out over 30 years. Not quite Federal Realty's 58-year record, not a Dividend King yet, but certainly on the way to be a Dividend King. Now, the company, again, has returned about 16% year to date. But let me show you on the valuation. You can see here shares announced still trading at a fairly attractive level of about 14 times compared to the normal valuation of 18.1 times. And you still get a very attractive 5.4% dividend that's well covered. So again, looking at the sum of those parts, I think Realty Income definitely is going to stay on the buy list. We think the company's got a lot more room to run. We think we're going to see potentially them bump their acquisition guidance, just like Agree Realty. Again, these rate cuts are like rocket fuel for these net lease REITs. So we think now total return estimate here is about 15 to 20% today over the next, say, 12 months or go. And again, I would not rule out any M&A activity. I think they've shown a history of that, and I think there's more of that to come.
Yeah, no, I think the size and scale of Realty Income is what sets it apart. It's part of why we like it so much. They can make deals that on the public and private side that nobody else can make. And, that helps me to sleep all night. I always say if all else being equal, I'd rather just own the big dog in the fight. And that's driven by money. It's driven by balance sheet. We like Blackstone, we like BlackRock. You typically go to the largest players in any given industry, and they're the strongest player. Well, Realty Income is certainly that in the net lease / commercial real estate industry. So, nothing bad to say about that company. Anybody that watched last week's video saw that is my largest REIT position. And, I love collecting that monthly dividend, and I'm sure I will for many, many years to come. So, Brad, thanks for those, your treat picks. We had our kind of spooky REITs earlier in the week. Here's the ones that Brad likes, all double-digit total return potential. So you got to love that, and all safe and growing dividends. So no complaints here. Love the picks, and looking forward to what everybody had to say about them in the comment section.
Great. I want to conclude this. One of my favorite books I read, probably 12 or 13, 14 years ago. It's called The Ultimate Dividend Playbook. I would encourage you. It's written by Josh Peters, by the way. And this is like the go-to book for dividend investors. I'm going to take one more quote out of here, and then we'll wrap it up, because I think this certainly is part of this whole opportunity set that we just spoke about with REITs. Quote, dividends speak louder than earnings. A company's pattern of dividend payments, its dividend record, can offer valuable clues to underlying corporate performance, clues just as valuable as those provided by earnings reports and other financial data, and definitely more useful than the conclusions someone might draw from looking at a 3-month stock chart. Dividends are more than information. They provide insight that any investor can use to make successful investments. So absolutely, to wrap up the sweet retweets, get them all together, Halloween special, this dividend payment is the ultimate sign of corporate strength. And I hope you all have some retweet treats in your portfolio. Thank you for watching today. Nick, look forward to seeing you again next week. We're going to see how the Warriors continue. And it'll be a great week. So you guys better rest up and get ready for this guy on the other side. Sounds like he's going to be, coming with his game.
Yeah, he's a tough player, but we'll see. Yeah, we'll get back to everybody next week with the football game, and maybe I'll have some Halloween candy in the video too. So thank you guys.
Thank you all for watching. Have a great week.
See you guys.
Hi, everyone. Thank you for watching today's episode of the Wide Moat Show. Please comment, like, and subscribe below, or go visit us at widemoatdaily.com. As always, happy swan, sleep well at night investing.